Financial market participants are usually a bit nervous in August. They fear that their holidays are going to be ruined by some financial market event. This year, most of them probably emerged unscathed, although there were some things in markets that are worth talking about. August has been a fairly mixed month for equity markets. On the one hand, you've seen the US perform relatively well, and on the other side, you've seen weakness in emerging markets, in Europe and in the UK. Some of this may be trade-related. On the one hand, you've seen the US, which is a relatively closed economy, perform quite well, and some of the more export-led markets like emerging markets or Europe have shown a little bit of weakness. In terms of emerging markets, we've seen a real focus on Turkey and Argentina. That's not very relevant in terms of their direct exposure for emerging market equities, but it's a sign that there's a broader concern around what US rates might mean for markets that have very large trade or current account deficits. It's an area that we'll continue to focus on going forward. We've generally taken the view that a hard Brexit or a no-deal Brexit would be viewed negatively by financial markets. It would see weakness in sterling and UK assets more generally. We also need to acknowledge that in that world there's an upside scenario. Perhaps you have another referendum, however unlikely that might be, or a negotiated outcome that markets take well. From a portfolio construction perspective, we want to try to capture the upside scenario, but also protect ourselves from the downside as best we can. So when we think about the portfolios overall, in general at the moment, they're fairly balanced in terms of sterling versus non-sterling exposure. We'll continue to monitor the situation closely, and if we see greater clarity on the likely outcome, we may start to move those positions around. In recent weeks, the focus in Europe has really been around Italy, and specifically the Italian budget. The government has made no secret of its desire to increase spending, even though Italian debt levels are very high. And Italian bonds have seen their yields go up, as bond market participants have shown some concern. Our UK portfolios don't have a great deal of Italian exposure, but this question could have an impact on European markets more broadly over the next couple of years.